The reason the Fed can't raise interest rates high enough to fight inflation is because it would create not only a depression, but a financial crisis, because there's no way that all the debtors could pay that debt. And so everything would implode, which is why the Fed is not fighting inflation, because it can't, but it can't admit that. So it's pretending that it will. And part of the pretense was the strong economy that was enabling this fight without the type of collateral damage that there would normally be when the Fed was fighting inflation, even though this time there should be much more collateral damage because we have more inflation than ever and we have an economy more vulnerable than ever to rising interest rates. But the Fed was hiding behind the facade of this super strong economy. Now, the whole time the Fed was claiming the economy was strong, it was actually in recession. The economy has been in a recession for all of 2022. In fact, back in 2021, when I was a lone voice predicting that inflation wasn't transitory and would get stronger, I was also predicting that the economy would get weaker at the same time. I forecast that the US economy would be in recession in the first half of 2022, and I got that right. But I said, even though the economy would be weaker than anybody thought, inflation would be stronger than anybody thought. So I got both right. My prediction was stagflation, but that the stagnation would actually be recession, not just slow growth. Well, now that the Fed has now been confronted with the data, and I always assumed that once the GDP numbers came out for the second quarter, that they would have to admit that we were in recession. In fact, they shrugged off the negative GDP in the first quarter and still pretended that we had a booming economy. But when we followed that up with the second quarter of negative GDP growth, I initially thought, well, okay, they're just going to have to admit there's a recession. But no, they haven't admitted it. They're still denying that there's a recession. And how are they doing that? Well, they're redefining what a recession means. Because for my entire career, we've defined recession, and so has everybody in government, everybody at the Fed. It's always been defined as 2 consecutive quarters of negative GDP growth. Well, we meet that definition because we just had that. In fact, the declines in GDP are likely bigger than what the government admits to because they are understating inflation in their deflator. So the economy is actually weaker than the numbers indicate. Yet despite those negative numbers, the Biden administration and the Fed claim that we are not in recession, that the recession doesn't actually mean 2 consecutive quarters. It means a broad-based decline in the economy, which is kind of subjective because somebody has to determine whether the decline is broad-based enough. Although from all the evidence that I've seen, it's very broad-based right now. I mean, housing's in recession, autos are in recession, retail, advertising, all sorts of unrelated parts of the economy are contracting, yet somehow that doesn't constitute a broad-based decline. So despite this evidence, the government continues to pretend that the economy is not in recession. And part of that is so the Fed can continue to talk tough about raising interest rates, because it's ignoring the damage that those rate hikes have already done and will continue to do. Because as the Fed continues to raise interest rates, GDP growth in Q3 and probably in Q4 will also be negative. And so we could have 3 or 4 or more consecutive quarters of GDP growth. Eventually, the Fed has to acknowledge recession. In fact, as the Fed raises interest rates to fight inflation, it undermines the economy because of all the debt service. It also helps push consumer prices higher because higher interest rates are just another cost that businesses have to pass on to their customers. And it's another cost that individuals bear who have debt. We have record credit card debt, student loans, auto loans, mortgage debt. All of these payments are influenced by higher interest rates. Now, I'm not saying the Fed is wrong to raise interest rates. The Fed needs to raise interest rates. In fact, it's the market that needs to raise interest rates. The Fed needs to get out of the way. That's what Paul Volcker did. He didn't put interest rates at 20%. He got out of the way. And the markets put interest rates at 20%, even though inflation was no higher than 13.5%. And of course, if we still measured inflation today using the same CPI that we used to measure it in 1981, we would be much higher than 13.5%. And the markets would obviously put interest rates maybe even higher than 20% if they were allowed to function. But they're not being allowed to function for the obvious reason that everything would collapse. Back in 1980, we could afford to pay 20% on our debt. We only had about 1 trillion in the national debt, not 31 trillion like we have now. But more importantly, most of that debt was locked in with 10 to 30-year treasuries. So higher interest rates only affected the immediate borrowing needs of the US government. Now, with about a third of the debt maturing every year, we have such a short maturity and we have such enormous current deficits that any big spike up in interest rates immediately bankrupts the US government. There is no feasible way of making those payments. They can't raise taxes high enough to do it. And of course, if interest rates went that high, we would be in a massive recession. And so tax revenues would collapse while government spending exploded. So there is no viable way to allow interest rates to rise to a market clearing level, but that is still the right thing to do. The Fed needs to fight inflation, and it can't do that without pricking the bubble in the economy that was created by inflation. So if you take all the inflation away, then the bubble collapses. We're going to have a massive economic collapse. We're going to have a worse financial crisis than 2008. Stock prices will crash. Real estate prices will crash. Bond prices will crash. The U.S. government will be forced to cut government spending dramatically, even on entitlements like Social Security and Medicare. And it will probably be forced to default on the national debt. Now, that doesn't mean that people who hold treasuries get nothing, but they're not going to get repaid in full. They're going to have to take a haircut. The debt is going to have to be restructured so that the principal is reduced to a level that the U.S. government could actually afford. Now, all of this stuff would be political dynamite. I mean, it would probably be suicide for whatever the party is in power that was forced to acknowledge all this, which is why it is not going to happen. The Fed does not have the political will to force all this to happen. So everything it's saying about its commitment to fight inflation is a bluff. The Fed will give up the inflation fight as soon as it's too politically dangerous to continue it, as soon as the collateral damage is great enough that the Fed has to pivot and then focus on the economy, on employment, on financial markets, because that is what the Fed has always done, and that is what the Fed is going to do. The question is, will the markets start to price in this pivot before it happens, or will they wait for it to actually happen? And what the markets still don't understand is what this means. Because while there are enough investors who understand that the economy is either in recession or headed to recession, those same investors also believe that the recession will do the Fed's work, that inflation will go away as a result of the recession, that as the labor market weakens and unemployment rises, that will also reduce inflation. That is wrong. Inflation is not caused by economic growth. It's not caused by low unemployment. It's caused by the deficits and Fed money printing. And money printing and the deficits are going to go up in the next recession, not down. Now, in the past, that monetization manifested itself in asset prices. That ship has sailed. We're beyond that now. We've gotten to the point where inflation is going directly into consumer prices, and that is going to continue. Oh, and by the way, the idea that the U.S. has a strong labor market is farcical. Just because we have an official low rate of unemployment doesn't mean the labor market is strong. In fact, the 3.5% unemployment rate is 6.7% if you include people that are working part-time involuntarily and discouraged workers. That used to be the actual unemployment number until they decided to change it. But of course, if you include the long-term unemployed, which the U6 excludes, you've actually got an unemployment rate above 10%. That's not a strong economy. You also have labor force participation, the lowest it's been this year at 62.1, and well below where it was before the pandemic started. That is not a strong labor market. Real wages are collapsing. Yes, workers are getting wages, but those wages pale in comparison to the increase in the cost of living. So when you have a labor market where workers are forced to accept pay cuts, that's not a strong labor market. In a strong labor market, workers are able to demand raises and their employers have no choice but to pay them. And a raise means that your paycheck goes up more than the cost of living, not less.
That's it for today, guys. If you found this video useful, then don't forget to like the video and share this knowledge with your friends and family. And don't forget to check out the full video, link is in the description. Thank you.